Welcome, Michael Kopinski, the Director of Research, and also the analyst following AEW Scripps. The stock symbol is SSP. I have an outperform rating on the stock. So I encourage you to take a look at our research reports on Channel Check. We'll wait everybody to get settled here and we'll get started. So I encourage you to take a look at our research on Channel Check and for the full disclosures on my company that I follow. Jason Combs is the CFO of the company. We have Carolyn Michelli over here as well to help address additional questions. This is going to be a little bit different format than what you might be used to in some of the presentations that you've been going to. This is going to be a fireside chat. I'm going to ask questions. And feel free to raise your hand at any point. If you have any additional questions, I'll address those as your hands are raised. So first of all, Jason, I was just wondering if you can just kind of briefly, for those that might not understand or know the company, kind of just briefly give us an update on the EW Scripps.
Yeah, so we are a media company with two primary segments. One is our local media segments, which is made up of more than 60 local television stations across 40 markets across the U.S., including two locally here in West Palm. And then we have a national network segment, which is made up of 8 national networks that are available through over-the-air broadcast, through pay TV, and through connected TV.
So one of the unique things about EW Scripps over the course of my career following you has been that the company has diversified from its traditional broadcast roots and invested in different businesses that eventually created a lot of value. I remember back in the 80s and 90s, you were in cable television and spun that off to Comcast, and then of course helped develop some networks like HGTV and the Food Network, and then spun that off. And one of the areas that you have started to develop into is your network business, and I was wondering if you might want to talk a little bit about that and how you've leveraged your cash flow from your local stations to get into the network business, and you might want to just describe why you did that.
Yeah, so I guess our national networks business kind of starts back with an acquisition we did in 2016, maybe, with the Cates Networks. Which was a group of multicast networks that were available primarily over the air with a little bit of pay TV. And we did that because it seemed like, for those not familiar with kind of the way broadcast spectrum works, if you're watching your ABC or your NBC affiliate with an antenna over the air, that takes up a piece of your spectrum, but there's this whole other piece which isn't being used. And so what's happened over the last so many years is a bunch of new networks or channels have been launched, and we saw the fact that we owned a bunch of Big Four affiliate groups, and we own a lot of broadcast spectrum, the opportunity to acquire these networks, and there was like a natural synergy that occurred. So fast forward to 2021, January 2021, we closed on the ION acquisition. So ION is a large national broadcast network, is actually the 5th ranked network behind the Big Four, ahead of the CW in terms of ratings. And that was sort of then the cornerstone that we could combine that with these multicast channels and some other networks that we've kind of spun up ourselves since then to kind of create this division, which I would say is scaled from the standpoint of it reaches any consumer who wants to watch these brands can watch them through free over-the-air television, through their connected TV, their Roku app, their Freevee or whatever else, or through pay TV, through a DirecTV or a Comcast subscription. And so there's a lot of natural synergies that happen by owning 8 networks, leveraging the back office behind it, leveraging your buying power when you're going out to acquire programming. And then we've been able to, once we've kind of combined this all together, to now identify areas of growth opportunity. One being, and I'm sure we'll talk about it eventually here, our sports opportunity, where we're leaning into women's sports, specifically on ION, at a time, I would say maybe we leaned in a little before most people did with the WNBA deal we won, and so real growth opportunity for us.
So let's talk a little bit about your two businesses. So let's first talk about local, and then we'll get into the network business. Mm-hmm. On the local business, the key strategy for local is always the two main drivers has been political and retrans, right? Because typically broadcast has been kind of like a GDP plus or minus type growth. And more recently, political was just off the charts for you, but it wasn't like that for everyone. Mm-hmm. So you might want to just describe what it was, the political for you this year.
So I'll talk about political. So first of all, political is sort of an every other year huge cash flow event for broadcasters. It's one of the reasons why when people value us, when people look at our, our leverage calculations, all those sorts of things, they do it on a 2-year blended cash flow because you see such a movement even year to odd year. We reported in our November earnings that we were going to do more than $340 million in political revenue for this year. So for some context, we started out the year expecting 210 to 250 million. We increased our guide in August to 270 to 290 million. We came in at more than 340 million. That compares back versus the last presidential election in 2020 of 265 million or so. So often in political, it comes down to your footprint. So I would say, when you look at the Senate races that were out there, we had the best footprint of anybody in our peer set. Montana was one of the most expensive Senate races of all time. We own clusters in every major market in Montana of 1 and in some cases 2 Big 4 affiliate groups. Ohio was another good footprint for us. Nevada, Arizona, Michigan and Wisconsin as well. The other thing you really saw in the presidential race was the expectations for presidential spending were not really, really strong going into the year, with the assumption of a Harris Trump race, and of a Biden Trump race. And when you saw Harris get introduced, you saw the amount of fundraising that happened, and you saw markets move to become more competitive. That really increased in some of those states, like I mentioned, Michigan, the amount of political spend. So we were really happy. I will say there's been, some of our peers who disappointed on their guides, but if you look at the whole dollars that went to broadcast, it continues to grow every presidential year to presidential year, midterm to midterm.
And the significance of political and why you should monitor the political is because of the margins on political and how that is used to pare down debt. So you might want to talk a little bit about
It's an
that.
extremely high margin revenue stream for us. We, back in probably like early 2010, 2012, something like that, 11, we created, we stood up a dedicated political sales office in Washington, D.C. It's staffed year-round so that we can always be, even in an odd year where there's not as much political spend, connected to the campaigns, to the politicians. And so I think that's a differentiator for us. And as I said, it's extremely high margin revenue. So it was a great year for us. And I think as we look forward, I believe that pie is going to continue to grow.
So another growth driver has been retransmission revenue.
Yeah.
And, does everybody understand what retransmission revenue is? Do you know what that means? Okay, so retransmission revenue is when the local broadcaster goes to the cable operator or satellite provider and charges them for that carriage. And so that's called retransmission.
By Congress to pass.
Yes, required by Congress to pass, exactly. So it just started in 2005, I think, when the broadcasters started going back and trying to get retransmission revenue from the cable operators, because cable operators are paying the likes of HGTV and Food Network and all these other programs, but not paying the local broadcasters for that carriage. So retransmission revenue has been a key growth driver for the industry for quite some time, since 2005. You might want to talk a little bit about the prospect for retransmission revenue growth. I mean, we've seen this huge growth in retransmission revenue, and now we're starting to see subscribers kind of fall off on cable and so forth. You might want to talk a little bit about the dynamics of what you look for in terms of retransmission revenue growth going forward.
Yeah, so first to kind of size it up for you, based on the guide we gave for the fourth quarter, or actually for the full year, we're going to do around $760 million in retransmission revenue this year. So it's a big piece of our revenue. We're a little over $2 billion in revenue, so it's about a third of our total revenue. I will also kind of break down a little bit what Mike walked through into kind of 2 different buckets. There is retrans were paid by what we call the traditional MVPDs, so think traditional cable and satellite, your Comcast, your Cox Cable, your DirecTV, your dishes. Then there is what we're paid by the virtual MVPDs, so your YouTube TVs, your Hulus, so on and so forth. And I break it down because it's sort of the tale of 2 cities. The YouTube and Hulu are smaller, but they are growing, and they've been growing now for the last 5, 6, 7 years. The traditional is what you see the decline on. When you look at the growth we've had the last, what was the stat we had in the deck we posted on the website? I think it was a 12% CAGR over the last 7 years. Yeah. And so really strong growth rate there in revenue. I think there is an expectation that the traditional side levels out as you continue to see rate increases when you come up for your renewal. Typically, they're on 3-year cycles, but you weigh those rate increases against the subscriber churn that's happening as people either cut the cord or are moving over to the virtual MVPDs. That being said, we think that nets against continued strong growth on the virtual MVPDs, and so we see it as a revenue stream for us, which will remain strong as we look forward. And I talked a little bit about sports earlier on the national side, which I'm sure we'll get into. But on the local side, we have 3 markets where you've seen the RSN, so Diamond Sports, Valley Sports, and what's happened with the RSN model the last couple of years. What you've seen is sports teams start to realize that those RSN models that have such limited carriage that's impacting their ability for fans to find them. And so you started to see multiple teams moving away from the RSN model and moving back to free over-the-air broadcast, including locally here, where the Florida Panthers transitioned this year to be on Scripps channels in West Palm, in Fort Myers, and in Miami. And so I bring that up because that is another opportunity for us to negotiate incremental retrans. And so if we have an independent station today that does not have sports on it, we might be getting paid retrans, but it's this big. When we suddenly can go to the cable company and say, okay, well now we have the Florida Panthers, or we have the Vegas Golden Knights, or we have the Utah Hockey Club, all teams that we have. So instead of paying us that, we now need this. That is something that I believe is another avenue for us to drive incremental retrans growth as we look out over the next couple of years.
What's great about that is that it's a consistent revenue source, and it's much more predictable than some of the vagaries of the advertising cycle that we might see. So it's a really good component that's 30% of your business.
Yep.
I was just wondering if you could just talk a little bit, you touched on it, about your sports strategy, and obviously you have your local strategy and your national strategy. And what's unique about sports is that people must watch that if they're sports fans, right? How many sports fans are in here? A lot of them? Yeah? Okay. All right. So why don't you talk a little bit about your local and your national sports strategy, which you just started to touch on?
So I'll start on the national side. So I alluded before to ION being a large national network, the 5th ranked network out there, reaching basically anybody who wants to watch it in the U.S. over the air through pay TV or through connected TV. And so we, several years ago, leaned into a strategy where we wanted to go to leagues. We're not going to the NFL. We're not going to the NBA. We're going to leagues that are, I would say, smaller, less viewed, but on the upswing. And so our strategy was to lean into women's sports. And so we signed 2 years ago a deal with the WNBA. So this was before the whole Caitlin Clark phenomena and everything else. And what we took to the league said, look, if you want to watch the WNBA today, rewind 2 years ago, if you're somebody who wants WNBA, it's really hard to find it because this week it might be on ESPN on Tuesday night. Next week it might be on ESPN on Saturday afternoon. There's no consistency. And if you think of some of the great franchises that are out there, it's Monday Night Football, it's Sunday Night Football now, Sunday Night Baseball. And so we said we can bring you a platform that reaches everybody, and we will give you a consistent night. Friday night, a Friday night franchise, we will block off 5 hours every Friday night on ION, and we think it'll help you grow your fandom. And so we won that deal. We just concluded year 2. We were ecstatic after the first year, and then after the second year now with Caitlin Clark and Angel Reese and some of the other rookies that came in, ratings were up, significantly. We actually had a 14-week season. 7 weeks, we had more than 1 million viewers on Friday nights. If you kind of look back the prior year, the WNBA finals the year before only drew 700,000 or 800,000, and so significant growth in fandom. So we timed that pretty well. We also have gone out and won the NWSL as well, and we just concluded. They just had their championship a week ago, I think it was. We just concluded year 1 of our NWSL deal. They have a franchise night now on Saturday nights. And that is another franchise or league that we believe has a lot of growth opportunities. And again, what we bring to them is if you want your viewers to be able to find you all the time on a set night across a bunch of different platforms, we're the place for you. On the local side, I touched on that earlier, but it's really around the fact that so I live in Cincinnati. I like the Cincinnati Reds, despite the fact they were terrible every year. And it's gotten really hard because a lot of the cable providers that are out there have dropped Diamond Sports off of there. And so now you're down to only one or two places in the marketplace where you can actually pay to watch them. And so that's impacted their ratings, that's impacted their fandom, that's impacted the excitement that's out there. And so we seized on that to go out and win the Vegas Golden Knights last year. We're coming off of their Stanley Cup win. We followed that up by winning the Phoenix Coyotes, and then now the Florida Panthers. And I think there are other opportunities that are out there. And again, what we're seeing in terms of the ratings that we're generating on our independent stations, they are significantly up versus what these teams were getting before. And they're seeing it. They're seeing it in their gate. They're seeing it in their merchandise. And so we think just a real value that we can bring to the table.
So one of the aspects of the stock this year, it's really kind of performed disappointingly because of the fact that we have all this influx of political, and it's actually well above what you expected initially and what I expected, and you have this ability to pare down debt more rapidly than you expected, but yet the stock has kind of performed dismally. And I was just wondering maybe if you could talk a little bit about the debt, and of course that was largely attributed to the Ion acquisition. But maybe talk a little bit about what your plans are to deal with the debt and where you expect that to be, and so forth.
Yeah, so to kind of rewind a little bit, I talked about us significantly growing our local TV station base between like 2016 and 2020, and then the Ion acquisition, and those have provided growth on the top line, on the bottom line. They've also come at the expense of a lot of debt. And shortly after the Ion acquisition is where you saw a significant downturn in the national advertising marketplace, and so that's impacted us no different than it's impacted AMC and Discovery and everybody else, Warner Brothers, everybody else who's out there. And so that has put pressure on some of our underlying metrics. Our net leverage has increased to 6 times as of the end of Q2. We have a laser focus, and we talk very openly about this, on our number one capital allocation priority being paying down debt and reducing leverage. And I'm happy to report we kind of peaked in Q2 at 6 times. At the end of Q3, we were down to 5.1 times, and we expect to be, we guided to being in the high 4 times range at the end of Q4. So we're making tremendous progress. One of the things I think is a bit of a differentiator for us versus some of our peer set is if you look back over the last 5 years and look at how we've used our cash flow, 99% of all discretionary cash flow we've had has gone towards debt pay down. Other peers have directed cash in other avenues. That's been our focus, and I think we've made a tremendous amount of progress. I think we're going to continue to make progress because what I've also talked about is on the earnings call is as we turn to 2025, a year where we are not going to have the political cash flow we had this year, but where we want to continue to making progress on cash flow and debt pay down. We have some real estate assets that we are currently in the process of selling that will generate cash flow next year, which we'll put towards debt pay down. We also are taking a pretty aggressive approach on expenses, and we actually, for our Scripps Network segment, we actually guided to a margin expansion of 400 to 600 basis points next year. That's largely on the back of some aggressive moves on the expense side, most of which we've already actioned and talked about publicly with the change in strategy on Scripps News and with some carriage fee agreements we have. And so we're doing the things to ensure that even in a year without political, we continue to generate cash flow and make progress on debt pay down and delever.
And just to, I think that in your presentation, you indicated that the real estate assets is not inconsequential. It was like 60 million, I think.
So we've got 60 million that is currently either under LOI or APA. We had guided to a range of 50 to 100 million, and we have some other deals we're kind of currently working still that could push us to the upper end of that range. We also, sort of separate from that, I'll bring up, we have one of our national networks that we've publicly talked about as being in a process, that our Bounce network, which is our African-American focused network, that is a great channel for us. We've grown it significantly since we bought it back in 2016, but we think can grow. That growth can be accelerated by a different owner, and so we've talked publicly around running a process on that, which would create another significant cash flow event, and we would do that at a deleveraging multiple.
That was a little bit of a disappointment that the guy that was actually going to buy the network actually pulled out. and now you're starting the process over. Where are you on that process? Maybe do you have a timetable for that process at this point?
So we're not putting a specific timetable on it. We had a deal that we were very far along in the process. We had actually, expected to be announcing a deal in early November. Instead, we had to announce that deal had fallen apart due to some, what I would say is multiple material changes in terms, sort of in the ninth inning, if you will. So we were disappointed, but we weren't going to, we're not, this isn't a fire sale. We're doing a deal because we think it's something, we think it's a valuable asset that can, create a significant event for us and be a great asset for somebody else. And so we're not going to sell it unless it's at the right price. So to your point, we've now re-engaged both with some people who were part of the original process, who we had kind of pushed to the sidelines as we focused on this one buyer, but we also had interest that was coming in later in the process from people who weren't involved initially, who are interested as well. So I would say we're focused on doing something as we look to 2025, but we're not really putting any more specific timeline on it.
And typically, when you get into a lower interest rate environment, that these stocks historically have performed pretty well, and so it's kind of disappointing to see that they haven't done as well now that we're starting to see interest rates decline. What do you think is happening in terms of national advertising? What's holding them back at this point?
I mean, so there have been some rate cuts, but I don't think they've been as much as people expected. Inflation has gotten better, but it's still not, where we need it. And so I think all of that is causing people to take a pretty measured approach from a national advertising perspective, which is impacting sort of everybody within the marketplace. When you talk about valuation and multiples, one thing we haven't really talked about that I kind of want to throw it out there because I think it's a huge positive for our industry is the expectation now for a Republican FCC. Trump has already announced who his nominee is going to be. If you look historically, Republican FCCs are much more in favor of deregulation for local broadcasters versus a Democratic FCC. The reality is we're a legacy business that is the rules, when you compare, we're competing in local markets against the Googles and all these other big tech companies, but the regulations are extremely slanted in their favor. There is an expectation that some deregulation happens in the next couple of years, whether that is changing the national ownership cap, whether that is changing the in-market ownership rules, where today you can only own one big four in a market. And so these things are all things that I think are viewed as positives for the broadcast industry and things that I think will move multiples as well.
Exactly, and I was going to ask you about the regulation. That was my next question, so you read my mind. How do you gauge the prospects? I mean, have you ever? I know it's early, and the administration is putting things together, but
they're just putting things together. I would say putting things together more quickly than they did under the first Trump presidency. And there were some pretty public comments that Brendan Carr, who's going to be the FCC chair, has out there around his view in terms of deregulation. So I think there's a lot of reasons to be optimistic. There is some question out there. I mentioned two things in particular there. One, the in-market ownership rules. The FCC, has the ability to change. The other likely requires the cap change likely requires an act of Congress, and so there's some question on that. The other thing that is not tied as much to the multiples today, but I think is part of our longer-term business strategy is around ATSC 3.0, the new broadcast standard. Today, there's the legacy standard, which is 1.0. There is this new standard 3.0, and right now, when we broadcast in every market, we have to broadcast in both signals. And there is a business model to be built on using some of your excess spectrum once you've converted completely to the 3.0 standard to send data wirelessly across broadcast spectrum as a complement or a replacement in some cases for 5G. There's a lot of really great use cases, but that's not going to become a business model until 1.0 is sunset.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then ChannelCheck truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since ChannelCheck is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why ChannelCheck is North America's leading source of research on the companies that just may change the world.